So we can now look at the required for question 1. So it says, refer to scenarios 1, 2, and 3. Discuss the VAT consequences for Artent Limited for the events or transactions described in these scenarios. Your discussion should include the value and timing rules with a clear explanation or reference to the Act so as to support your answer. Your answer should only discuss the events that took place in the 2022 year. Sorry. Now, the one thing I just want to point out to you is you'll see that this required I specifically indicate that you should include the value and the timing rules. You should always include the value and the timing rules in a discussion question for VAT unless they specifically tell you not to do it. So occasionally you'll see that the question will say you're not required to discuss the timing rule, for example. But they don't have to tell you like I did here to do this. This is almost just to also get you into the habit of making sure that you do include it. Okay. So let's have a discussion on it. So scenario 1. So actually before I do scenario 1, let's just talk about timing and we talk about the value rules. Now, the first thing that you need to understand about the timing and the value rules for VAT is that the timing rules are usually discussed in section 9 and the value rules are usually discussed in section 10. There are some exceptions where they're discussed elsewhere also, but those are in general where they are discussed. Now, what I want you to remember is that we have the general rule for both of these. And these general rules are the more common rule, or the most common. So this is applicable to all transactions for VAT unless there's a specific rule. And the timing rule says it is the earlier of invoice or payment. And the value rule says you do it on the consideration. Now, consideration means the full amount, including VAT. Those are the usual rules. So, unless we know specifically that there is a different rule, these are the rules that we will need to discuss. Okay, so please remember that, guys. Those are your general rules. So, let's go and take a look. This case of the question. So question 1, scenario 1. So scenario 1 was a situation where we purchased the land in 2005. That's not the tax year that we're looking at. In 2006, a warehouse was erected. Here's the year that we're looking at. On 10 April 2022, there was fire that was set to the warehouse, and we submitted a claim to the insurance, and we got money from it. Right, so scenario 1, and guys, I'm not going to write it out all of it. There is a detailed discussion question. I'm just going to try and show you what we would discuss. So the first thing that you would have to discuss in this case, you would have to discuss why we are doing VAT on this, and that would be because section 8.8 tells you that an indemnity award is a deemed supply of services. Alright, they tell you in section 8.8 that the indemnity amount that you've received equals the consideration. And then we know from section 10, section 10.2 specifically, that the consideration equals the value of the indemnity award. So in this indemnity award, we received 5.3 million rands. Which is for the warehouse and for the trading stock. So 5.3 million rands That's the amount that was just deposited into our bank account. You don't have to split them out. And that gives us 691,304. The value rule in this case is contained in section 88, and it tells you when the indemnity is received. And in this case, they tell you that the indemnity was received on the 22nd of May 2022, I mean, which is the, what did I say now? 22nd of May 2022, so 22nd of May 2022. So that will be in the May VAT return. Why the May VAT return? Because we are a category C VAT vendor. So we do monthly VAT returns. Okay, so that's it, basically for scenario 1. Okay, so we can now look at scenario number 2. So in scenario number 2, what happens here? This is where we are seeing the situation where the asset was sold. So just as a quick little reminder of what happens here, they say that after the warehouse was destroyed in that fire that we saw in scenario 1, the management decided to sell the property. So they sell that land to Mr. Clifford Switz for $510,000 excluding VAT. He has to pay 40%, 30% and 30% on these dates. Okay, now guys, actually I just thought about it now before I continue. This timing rule is section 9.1, and the value rule is section 10.2, where we see that these specific rules. So just again for your reference sake. Okay, so what happens in this case now is that we are seeing that there is a sale of property. And again, what is important for you to remember here of this land is that it's not the same as in income tax, where we distinguish between goods which are capital in nature and goods which is revenue in nature, and then the one is gross income and the other one is not. For the sale of property, or to calculate or to determine if there's output VAT rather, you always test it against section 7.1a, which says there must be output tax if there's a supply by a vendor of goods or services in the furtherance of an enterprise. So that sale of the land is subject to output tax, and already there was part of our answer what we need to discuss. So scenario 2, there you'll basically say there must be output tax, and this is per section 7.1a. Why? Because there's a supply of goods by a vendor in an enterprise. Now let me just also quickly make one comment here. You see me keep referencing to the actual act. Now this required tells you that you can give a clear explanation and or reference to the act. Now you should not be in a situation, even though when they ask you in an exam, there will usually be 1 or 2 marks allocated for giving references to the act, if they do it. But what's more important is that you have either an explanation or you can give a reference to the act. So if you don't know the act number, but you can give an explanation from what the act says, why that should happen, that's also fine. Of course, if you do know exactly what the act says and you can give a proper reference to the act, that just makes it a little bit quicker for you potentially, because you can just write down the act number. You can say refer to section 7.1a, but otherwise just keep it nice and simple. Okay, so let's just go back. So that's the first thing. That is the reason why we are calculating it. So now we have to discuss timing and consideration and value. So first up, the value rule in this case again is just the general value rule, which says we calculate it on the value of the consideration. Right, then the timing rule. Okay, so the timing is a little bit interesting when it comes to fixed property, because the first thing we do is section 9.3d of the Act tells us that you have to calculate it on the earlier of registration or payment. But what is important to remember about fixed property is that section 16(4), well, in this case because we sell, if we bought it, you'd find it in section 16(3). But in section 16(4), it tells you, it gives us a special timing rule. And that special timing rule says you must account for output tax when the seller receives payment. So this means, thus, on these dates given, 1 July, 1 September, 1 November, 1 July, 1 September, 1 November, September and November, you will account for the output tax. They say it's 40%, 30/30, and the amount is 510. So 510 times 40, 510 times 30, 510 times 30, and because the amount was excluding VAT, we multiplied by 15%. If you went and you said times 15 over 115, guys, you would not get any marks there, so be very careful of that. There's no half marks or anything like that when it comes to that. You have to get it right. Okay, 30,600. And, well, let me just actually write it out a little bit better. 30,600 and 22,950. Okay, that's it. Again, the fact that it was registered on the 1st of August does not influence the seller. It's only when we're looking at a buyer, and only when that buyer is buying it from a person that did not charge output tax. So scenario number 3. So now scenario number 3, this is the one where in the 10th of Jan goods were sold. On the 1st of February they paid 85,000, and then we refunded on the 1st of July. Okay, so let's get that discussion out. Okay, so first up, sale of goods. You must calculate output tax. Why? It's again because of section 7(1)(a). I'm not going to write it out in full, but again that's because there's a supply of goods by a vendor in the furtherance of an enterprise. So that means in the January VAT return, okay, let's actually, before we do it, section 9(1) says earlier of invoice or payment. So the invoice gets issued first. Section 10(2) says it's on the consideration. Okay, so thus in was it January? Yes, we calculate output tax, and the output tax is 58,000 times 15 over 115. Okay, then when you receive payment on the 1st of February, what happens in February? There's no VAT effect at this point in time. So yes, we received 85 instead of the 58, but we don't do anything with it. Now from this date onwards, 4 months later, so 1st of March, April, May, June. So 1st of June. Section 8 27 tells us, because the refund was not made after 4 months, we raise output tax. So the output tax is the 85,000 minus the 58,000, that calculates the difference, times 15 over 115. Okay, so 3522. Then we pay it on the 1st of July, and we can claim input tax then, and the input tax is the 3522. Now I'm giving it to you guys here, but this is the reference section 16.3M for that. This is specifically a reference that you don't see often, so if you didn't get that, guys, I really wouldn't worry about that too much. Okay, so let's just quickly jump to our solution and go and see. So scenario 1, this is where there's indemnity award. Let's just see how it goes through it. So it's deemed consideration for the supply of services, so we have to have output tax. Section 10.2 says it must be on the consideration. Section 8.8 tells us that the amount received is consideration, so the output tax is calculated as that amount. Section 8.8 gives us the timing. So you can see, you give the rule, why are we calculating output tax? You give the consider the value rule, you give the timing rule, and obviously you show your calculations. Scenario 2 is where we now sell the land. So why are we calculating that? Because of section 7.1a tells us the supply of goods by vendor and the furtherance of the enterprise has VAT. What is the value rule here? In this case, there's no special rule for property, so we must use the consideration, which is 510. Section 9.3d gives us the timing rule, early of invoice or of registration or payment, but then we've got section 64 overrides it. So here we just do that calculation again, times 15, not times 15 over 115. Scenario 3, again, why are we raising output tax? First of all, is the question. Because the supply of goods by a vendor in the furtherance of the enterprise. Give the calculation. Give us the timing rule over here. Early of invoice or receipt. Okay, that's for the sale of that 58,000 rands. Then we don't pay the excess. You will say, why are we raising output tax? Because it's not paid within 4 months. And then why are we claiming the input tax? So you can see it's really just going through a step by step and saying, why am I doing this? Why should you be doing that? Okay, and that's it for question number 1. Next video, we'll continue with question number 2.